This is Amy Zimmer from Holland Hunter Realtors with your real estate term of the week. Your credit score is a major factor in whether or not you'll be able to qualify for a home loan. In addition, those with a higher credit score are more likely to better obtain interest rates and may be able to secure a lower down payment. Those with poor credit may not be able to secure a mortgage at all. And if they do, the mortgage rate could be higher, meaning higher interest payments each month. A credit score is a consumer evaluation system that informs creditors or lenders how likely it is that you will repay future debts. Credit scores range from 300 to 850, with higher scores being better. Typically, any credit scores above 700 are considered good. The majority of U.S. consumers fall in the 600 to 750 range. The higher the score, the more likely a creditor will agree to lend money to a borrower. Creditors can determine their own requirements for a borrower's score, with some even developing their own credit scoring programs. The two most common credit scoring programs are FICO and VantageScore. There are 5 primary factors that determine the strength of an individual's credit score. The first is payment history. Whenever borrowers make on-time payments to credit cards, this helps improve their credit score. Credit scores are lowered when payments are missed and an account goes to collections or a borrower files for bankruptcy. The second determining factor in credit scoring is the way an individual uses their credit, which considers the number of accounts with balances and the total amount of debt owed. The third factor is the length of a borrower's credit history. This factor assesses the average length of time the borrower has held all their credit accounts while considering the oldest account and when it was opened, as well as the most recent. The fourth factor is the type of accounts that the borrower holds, which is also known as credit mix. The types of accounts managed by the borrower may range from car loans or mortgages, known as installment accounts, to credit cards, which also are referred to as revolving accounts. If both of these types of accounts are managed responsibly by the borrower, this will help improve your credit score. The final major factor in determining credit score is how recently a borrower has opened or applied for new avenues of credit. Neither credit scoring program considers personal details about the borrower, such as national origin, sex, age, or race. They also do not track personal financial details such as an individual's employer, salary, job history, although individual lenders may consider this information when determining eligibility and approval in conjunction with a potential borrower's credit score. The ability to be approved for a car loan or a mortgage for a new home directly corresponds to an individual's credit score. Once approved, the fees and interest owed can also be determined by a credit score. Credit scores are even used by non-lenders, such as landlords, to decide whether or not they will rent an apartment to an individual. One of the best ways to improve a credit score is to always make sure the minimum payment for each debt is made monthly. One late payment can remain on a credit report for up to 7 years. It is also important to keep credit card balances low. Low credit utilization rates help keep credit scores higher. Borrowers should also make sure to have open installment accounts that are reported to credit bureaus, such as student loans, auto loans, and home loans. Finally, applying for loans or credit only when needed is very important. Each inquiry into opening a new account causes a borrower's score to drop slightly. For more information on your credit worthiness, talk to your local lender.